Hello everybody, this is Philipp Jonas for Kalamazoo Valley Community College. And in today's lecture we're going to discuss the influence of monetary and fiscal policy. In our last lecture we learned about the concept of aggregate demand, which shows the total purchases of goods and services in our economy. And we learned that it was downward sloping for three reasons: the wealth effect, the interest rate effect, and the exchange rate effect. For the start of today's lecture, we're going to focus on the interest rate effect. This effect is not only the strongest out of the three in the US aggregate demand curve, but more importantly, is the fundamental channel through which monetary policy affects aggregate demand. To that end, we're now going to look at the interest rate effect using a simple supply and demand diagram of money. Armed with that model, we're going to revisit how the interest rate effect explains the downward slope of the aggregate demand curve, and then also use it to explain how monetary policy has an influence on aggregate demand. This supply and demand model of money is also referred to as the theory of liquidity preference. It's a model that explains interest rates in terms of the supply and demand for money. Now, if you've been paying close attention, you might notice that we already have a model that explains the interest rate in our economy, and that's the market for loanable funds model. If you go on to intermediate macroeconomics, you will learn how to combine both of those models, the market for loanable funds and the theory of liquidity preference, into one model, often referred to as ISLM, that has both of those markets in simultaneous equilibrium. For our purposes, simply rest assured that somehow it makes sense that we have two separate supply and demand models that both explain interest rates in our economy, and that in the end they are totally compatible with one another. So a supply and demand model of money. That's something we had seen before as well in our chapter on monetary growth and its effect on inflation. The money supply, same as then, is set by the central bank of our economy. So in the case of the United States, the Federal Reserve. While money demand reflects, out of all the wealth that consumers hold, how much of it do they want to hold in the form of money as opposed to other assets, such as bonds or stocks, for example. Last time around, when we looked at the supply and demand of money, we used it to explain the price level, holding other factors in our economy constant, such as the interest rate. The theory of liquidity preference uses the supply and demand of money to explain the interest rate, holding the other factors in our economy constant, such as the price level. So let's have a look at this model. As always, we have the quantity of the thing that's being modeled on the x-axis. So in the case of our model here, that's the quantity of money in our economy, such as M1 or M2. And then we have the value or price of the thing on the y-axis, which brings supply and demand into equilibrium. For the theory of liquidity preference, that's the interest rate. First, let's have a look at the supply curve. As before, the supply for money is perfectly inelastic or vertical. That's because our central bank can determine how much money exists in our economy, and no other changes will throw that off course in this model. Secondly, we have the demand curve. As is traditional with the demand curve, it's downward sloping, but let's briefly explain what that means in this context. If interest rates are very high, like up here, that means bonds are paying a very high interest rate. So you would probably want to hold less of your wealth in the form of money, even if that makes things less convenient for you, so that you can have more in the form of wealth in bonds that pays you a nice and high interest rate. As interest rates fall, the demand for money increases. Now it's more convenient to hold more of your wealth in the form of money, and you're not giving up nearly as much by not having it in the form of bonds. You put these two curves together, the supply of and the demand for money, and we end up with an equilibrium interest rate for our economy. That's all there is to the theory of liquidity preference. We're now going to use this model to explain two things. Number one, why does the aggregate demand curve slope downward? That's called the interest rate effect. And then number two, one of our new topics for today, how does monetary policy affect aggregate demand in our economy? So let's start out with the interest rate effect. Reminder, this is one of three reasons why the aggregate demand curve, here shown on the right, has a downward slope. Over here on the left, we have our new model, the theory of liquidity preference. Last time around, when we looked at the downward sloping aggregate demand curve, we talked about it in terms of a rising price level. This time around, let's talk about a falling price level. We want to explain why when the price level in our economy falls from, let's say, P1 to P2, why purchases in our economy increase. So a movement along the aggregate demand curve to a lower point. And the only one of the three effects we'll focus on here is the interest rate effect. Of course, the other two would have an impact as well. The price level in our economy decreases. That's step number one. Now recall, price level is one factor that determines money demand. Money is used to buy goods and services. If the price level falls, you can hold less money to buy the goods and services you want to buy. That means your demand for money decreases. Notice that leftward shift of the money demand curve. Now let's have a look at the theory of liquidity preference, what this reduced money demand does to interest rates in our economy. As you can see from the new equilibrium, the interest rate has fallen. We already discussed this phenomenon in the last lecture, but then we did it as a narrative that when the price level falls, people will hold less money, more bonds and stocks and such, and that brings interest rates down. Now we're doing it in terms of the supply and demand model. But what impact will the lower interest rates have over on the aggregate demand side? Well, there's of course one form of spending in aggregate demand that is highly sensitive to interest rates: investment spending. When interest rates fall, investment spending increases. So going from start to finish, a lower price level going from P1 to P2 causes higher investment spending going from Y1 to Y2. The underlying reason is that the lower price level leads to lower interest rates, which encourages investment spending. This is called the interest rate effect. Please remember that it explains a movement along the aggregate demand curve. That's because this effect began with a change in the price level, and anytime the price level changes, we're moving along the aggregate demand curve. Now let's get to the new use of this model. Let's talk about monetary policy. So first things first, monetary policy of course refers to what the central bank, in the case of the United States, the Federal Reserve, does. Specifically, the Federal Reserve can vary how much money exists. When you hear about this in the news, this is often talked about as the Federal Reserve changing interest rates, which is a good shorthand way of explaining what's going on. When the Federal Reserve makes monetary policy, they typically do so in order to effect a change in the so-called federal funds rate. That's the interest rate that banks charge each other on short-term loans. So even though the Federal Reserve makes this happen by changing how much money exists, the ultimate goal is changing that federal funds rate. And that change in interest rates will have an impact on the aggregate demand curve. Specifically, it will shift the aggregate demand curve. That's because this story does not begin with a change in the price level, but rather with a change in the money supply. Let's go ahead and go back to our models. Again, on the left, the theory of liquidity preference, on the right, the aggregate demand curve. This time around, we're discussing monetary policy. Let's say the Federal Reserve engages in contractionary monetary policy. This is monetary policy designed to slow the economy down. You engage in contractionary monetary policy by reducing the money supply. The objective is, when the money supply is reduced, as pictured here, the interest rate in our economy will rise. That's monetary policy. What's the impact on aggregate demand? Well, when we look at the aggregate demand curve, there's one type of spending in there that's highly sensitive to interest rate changes: investment spending. Higher interest rates lead to lower investment spending. So we're going to go from our current level of spending, represented by this dot on the aggregate demand curve, and we're going to move that dot to the left. Notice that means we're not moving along the aggregate demand curve. Instead, we are shifting the aggregate demand curve itself. Now there's a lower amount of spending at any price level. One more time. When the price level changes, you move along the aggregate demand curve. When anything else changes spending in our economy, such as monetary policy displayed here, you shift the aggregate demand curve. What you're looking at here is contractionary monetary policy. Monetary policy designed to reduce aggregate demand. If, on the other hand, you wanted to engage in expansionary monetary policy, you run the process in reverse. You add to the money supply of the economy. That lowers interest rates, and the reduction in interest rates will lead to greater investment spending. This will shift the aggregate demand curve to the right. And that's monetary policy for our principles level course. But monetary policy is not the only tool in our toolkit. In addition to influencing aggregate demand by changing the money supply, we can also influence aggregate demand by changing government spending and taxation levels. This is referred to as fiscal policy. Fiscal because it's made through the government budget. Same as, for example, a fiscal year would refer to the time span over which you run your budget. Fiscal policy also comes in an expansionary and contractionary type. Expansionary fiscal policy is designed to shift aggregate demand to the right. You do this by either increasing government spending or decreasing taxes. Or in simpler terms, if the economy's government is already running in a budget deficit, by making the budget deficit bigger. That's expansionary policy. Number two, contractionary fiscal policy designed to slow the economy down. You can do that by cutting government spending and or raising taxes. This will shift aggregate demand to the left. Again, if our government is already running a budget deficit, you can think of anything that makes the budget deficit smaller or perhaps even moves it into balanced or surplus as contractionary fiscal policy. So the fundamental idea of fiscal policy is very simple. If, for example, we are in a recession because aggregate demand is too low, the government can stimulate aggregate demand by spending more money or cutting taxes. But there is quite a bit more detail for us to study here, because when the government engages in fiscal policy, it affects aggregate demand in more than one way. Let me explain. This is referred to as the multiplier effect. Here is an aggregate demand curve. Let's say the government plans to move that aggregate demand curve to the right. So we'll be engaging in expansionary fiscal policy. For example, let's say we increase government spending by $20 billion. So if we look at our aggregate demand curve, whatever level of spending already existed, we're now adding $20 billion to it. Aggregate demand curve shifts to the right by $20 billion. It shifts because the story did not begin with a change in the price level. But there is a knock-on effect here that's called the multiplier effect. Since for macroeconomy, spending equals income, when we have additional $20 billion of government spending, this raises incomes across our economy. And those consumers who now have higher income will tend to spend some of that additional income, in turn raising consumption spending in our economy and shifting the aggregate demand curve even farther to the right. In other words, when the government engages in expansionary or contractionary fiscal policy, the effect of this policy is a multiple of the actual amount of change in government spending or taxes. Now we want to get a mathematical handle on how big this multiplier effect is. In real life, this is fiendishly difficult because it isn't just about how much money the government spends. It also depends on how it is spent and how consumers react to this. If we have the government spend money in a way where consumers will save most of that additional income, the impact on aggregate demand will be smaller. But if we have the government spend money in ways that encourages additional spending, the multiplier effect will be stronger. So how can we wrap our mind around this? Well, by massively oversimplifying the problem. Let's make some assumptions. Let's say when the government increases spending, no matter how it does it, consumers always take extra income and spend a constant fraction of it. This constant fraction is referred to as the marginal propensity to consume, or MPC for short. Real life is not that simple. But if it were, the math becomes much easier. So for example, let's say the MPC in our economy is 0.8, 80%. That means anytime the government spends additional money, $100 for example, consumers always respond the same. They spend an additional 80 of those $100, saving the remaining $20. And, a little hidden in the background, let us also assume that all this additional government spending, private consumption, all that additional income has no impact on investment spending and no impact on net exports. Again, those are unrealistic assumptions. In real life, if consumers spend more money, for example, surely some of that will be spent on imports, having an impact on net exports. But our oversimplified perspective allows us to construct a simple formula for the multiplier that may not be real-life accurate, but it will give you the right intuition for how the size of the multiplier depends on the behavior of consumers. Let's start with our national income accounting identity, y equals c plus I plus g plus nx. And in a second, I will add some notation here. Please be reminded that a Greek uppercase delta represents the change in a variable, as opposed to the level of a variable. So first, let me explain what we're modeling here. Expansionary fiscal policy. Let's say the government spends another $20 billion. That means government spending increases by $20 billion. And this $20 billion in spending becomes income in our economy. This additional income then triggers additional consumption. That additional consumption triggers additional income. That additional income triggers additional consumption, and so on and so forth. Along the way, we'll assume that investment spending does not change, net exports do not change, and the only change in government spending is that initial change when the government engages in the expansionary fiscal policy. Let me show you how you can solve this formula for the eventual impact on GDP that additional $20 billion in government spending will have had. Step number 1, we apply the delta operator to both sides of the equation. So on the left-hand side, GDP becomes change in GDP. On the right-hand side, consumption becomes change in consumption, government spending becomes change in government spending. Why are we doing this? Because we are proceeding with that strong assumption that investment spending and net exports don't change. If that's true, and then you take the delta of I and nx, the delta of a variable that's unchanged is always 0. They drop out of the equation. And that's what that first assumption gets us, makes the equation much, much easier. Now let's get to the second assumption. By how much does consumption change when our consumers have additional income in their pocket? Well, we're making a big simplifying assumption here. Anytime the consumers get additional income, they consume a constant fraction of it, the MPC. Let's substitute that in. Let's replace change in consumption with whatever the change in income is times the marginal propensity to consume. At this point, we can solve our formula. We can calculate for the amount of government spending that we saw increase, 20 billion here, how much will GDP increase? We've got our change in GDP here on the left-hand side of the equal sign and right here next to the MPC. So solving this formula, we can solve for delta Y, the change in GDP, being equal to the change in government spending, delta G, times this constant right here. Just drawn a red box around it. This constant is referred to as the multiplier, and it's equal to 1 over 1 minus the MPC. Let's plug in some numbers for our example. In our example, the government spent 20 billion additional dollars, so delta G, that's 20 billion, and the MPC was 0.8. Plugging that MPC into this formula, 1 over 1 minus MPC, 1 over 1 minus 0.8, that's 1 over 0.2, that's the number 5. We would say that the multiplier is equal to 5 in this example. So when the government engages in $20 billion of additional spending, the impact on GDP is 5 times as much. 5 times $20 billion, GDP would rise by $100 billion. This includes both the initial change in government spending, the 20 billion, and all the additional consumption that gets triggered. So that's an all-in change. The total impact on GDP will be $100 billion. Now, in real life, the multiplier effect is not that strong because some of that additional income and spending will reduce investment spending and will reduce net exports. So while 5 is not a super realistic number, what is really good about this formula for the multiplier, 1 over 1 minus the MPC, is that it shows us how the multiplier effect changes depending on how consumers behave. So in our first example, we said consumers behaved with an MPC of 0.8. Every time they get an additional dollar in income, they spend 80 cents of it. What if the MPC was lower? For example, 0.5. 1 over 1 minus 0.5. That's the number 2. So with a lower MPC, you would have a much lower multiplier. Now let's increase that MPC number. If the MPC was 0.75, 3/4, then the formula gives us 1 over 1 minus 0.75. That's a multiplier of 4. And finally, let's go really big and let's say the MPC is 90%. 1 over 1 minus 0.9. That's a multiplier of 10. And here then is the fundamental phenomenon. Fiscal policy is more effective the bigger the marginal propensity to consume is. That's how it can have an impact beyond the initial change in government spending. This works in both directions. If the government reduces spending, the contractionary impact on our economy will also be equal to however much the change in government spending is, this time it would be a negative number, times that multiplier, 1 over 1 minus the MPC. And that's fiscal policy. But let's dig in a little bit more into this phenomenon of the multiplier. First of all, the multiplier effect, the idea that changes in spending change aggregate demand by more than that initial change in spending, doesn't just apply to changes in government spending. Any, if you will, external shock to spending on our economy sees its effect multiplied. For example, let's say there is a recession abroad, and as a consequence, there's $10 billion fewer exports out of the United States. Foreign entities are buying $10 billion less of US exports. Initially, that makes net exports fall by $10 billion. But that also means less income for the consumers in our economy. So they will cut back their consumption spending. And the exact same multiplier effect would play out, leading to this decrease in exports having a much bigger contractionary impact on aggregate demand than just the initial $10 billion. This is one of the reasons that explains why macroeconomies react so harshly when there's a surprise shock to the economy. It's because these shocks become multiplied. Let's mention something else about the multiplier effect. As I mentioned, it's not really as big as our simple math suggests, because some of the changes in income also affect net exports and investment spending. We'll only briefly discuss one of these two counterbalancing effects. When there's a change in aggregate demand that changes the income of our consumers, this has an impact on interest rates, which will impact investment spending and thereby make the change in aggregate demand smaller than it would otherwise be. You can think of the multiplier effect and the crowding out effect as being two effects that push against each other. The multiplier effect makes aggregate demand change by more than the amount of fiscal policy. The crowding out effect puts a brake on that. Now, the reason we're going to discuss this particular effect is that it can also be explained using the theory of liquidity preference we talked about at the beginning of this lecture. Let's have a look. Over on the right-hand side, we've got the aggregate demand curve. Over on the left, the theory of liquidity preference. Again, we're going to start with the government increasing spending by $20 billion. This by itself shifts aggregate demand $20 billion to the right. Now, earlier I showed you the multiplier effect. This additional spending would trigger additional consumption, pushing aggregate demand even further to the right. But let's ignore that this time around and instead focus on the pushback effect, crowding out. When aggregate demand increases by $20 billion, all that additional spending increases money demand. Money demand is influenced by how much money is spent. But let's look at the theory of liquidity preference. What happens when money demand in our economy increases? Well, interest rates rise to a higher level. And there is one type of spending in our economy that's particularly sensitive to changes in interest rates: investment spending. These higher interest rates will reduce investment spending and aggregate demand. in turn making aggregate demand go to a number less than that $20 billion increase. Again, crowding out pushes in the opposite direction of the multiplier effect. This also explains why economic policy is most powerful when the government and the central bank work hand in hand. If the government engages in expansionary fiscal policy, like this additional $20 billion of spending here, one of the factors that makes fiscal policy weaker would be the resulting rise in interest rates. But what if the central bank also increased money supply in order to keep those interest rates low? Then fiscal policy will have an even stronger effect. You get the shift in spending, the central bank keeps the interest rates low, and then the multiplier effect makes that spending have even more impact on aggregate demand. But this about reaches the limits of what we are going to discuss in a principles level course on macroeconomics. So let's instead finish out by how we think about this type of monetary and fiscal policy in macroeconomics today. Collectively, this is often referred to as active stabilization policy. Active in the sense that Congress and the Federal Reserve are making active decisions to manage aggregate demand, and the objective of managing aggregate demand is to make our economy more stable, to make the business cycle less severe. Now, this argument for active stabilization policy has been around for quite some time now and was described by famous economist John Maynard Keynes as being useful to counteract the animal spirits of our economy. The idea that there are waves of optimism and pessimism that wash over our economy and cause these unexpected changes in aggregate demand, giving us business cycles, and then the government can push in the opposite direction by managing aggregate demand. Animal spirits is not something we talk about very much anymore in this day and age, but a small successor remains. We still refer to bull markets and bear markets. That's an example of animal spirits. And of course, it's not just psychology that can make our economy susceptible to business cycles. Just to give a few examples of fluctuations that can hit our economy, booms and recessions abroad have an impact on our economy, or for example, stock market booms and crashes have an effect on our economy. And that's just some of the things that can throw us off course. I bet you can think of some other events that would lead to sudden, unexpected changes in aggregate demand. Now, if policymakers just sat by, if the government and the central bank did nothing, the argument goes that these business cycles are quite harmful to workers, consumers, and businesses. So the case for active stabilization policy is really straightforward. Use monetary and fiscal policy to move aggregate demand in the opposite direction of what the unexpected surprise did to our economy. So in other words, if GDP is falling below what we consider to be its natural rate, increase the money supply to lower interest rates and increase government spending or cut taxes in order to bring more spending into our economy. Vice versa, if you are worried that the economy is overheating, which will lead to excessive inflation, slow down the economy by raising interest rates through a reduction in the money supply and by cutting government spending and raising taxes. This will make business cycles less severe and reduce the harm they inflict on the participants of our economy. So who could disagree with such a prescription? Well, economists, of course. We are quite capable of disagreeing with ourselves. But before I show you the arguments against this type of economic policy, let me just mention some examples of where this type of active stabilization policy was used. For example, when John Kennedy ran for president, he pushed for a tax cut to stimulate aggregate demand. When George W. Bush ran for president, he pushed for a tax cut to stimulate aggregate demand. It's the same playbook across the entire political spectrum. This is modern macroeconomics and is quite settled. So what about that disagreement then? Well, it's not that active stabilization policy doesn't work. The concern is, should we always use it? Because while it does work, it doesn't work immediately. It works with something we call lag. Lag. You may have heard this term before when you are playing video games. It's the delay between when you move your controller and when something is actually happening in the game. You've probably experienced that the bigger the delay is between your action and the result, the harder it gets to hit your target. Well, think about monetary policy for a second. Fundamentally, the Federal Reserve's controller does one thing in our economy. It changes how much money exists. In response, our economy changes its interest rate, and then the idea is that that changes investment spending in our economy. So in other words, maybe somebody builds a house because interest rates are low that they wouldn't have built if we hadn't lowered interest rates. But think about how long that takes. How long is it going to take till a change in an interest rate actually leads to something being built or not being built? There is a lag of many months, perhaps years, between the action and the result. So the Federal Reserve has a very powerful controller, the money supply, but it's playing a game with a lag that's 6 months or longer. That's really hard to play. And what about fiscal policy? Well, fiscal policy also has a big lag. In order to change government spending or taxation, you require an act of Congress. Sometimes we joke that if something's taking a long time, does this take an act of Congress? Fiscal policy literally takes an act of Congress. And for Congress to find agreement, well, let's just agree that that can take a long time as well. So active stabilization policy works, but it works with a lag. So if you find yourself in a recession, for example, that's relatively mild, that will be over all by itself in less than a year, then your stabilization policy might actually hurt. Because by the time it has an impact, the underlying problem has gone away, and now you're throwing the economy off course in the opposite direction. You're making our economy less stable. That's why when it comes to very mild recessions, sometimes it's better to do nothing and wait for the economy to correct itself. On the flip side, if we hit a very deep, very long recession, something that we know we'll be in for years anyway, then stabilization is very powerful, and we don't really have to worry about the lag problem because we know it's still going to be around by the time the underlying effect is needed. Finally, there's one more type of stabilization policy that's somewhat more cutting edge and is just starting to be used in advanced economy. The idea of automatic stabilizers. What if we could put stabilization policy into our economy that's rule-based, so it automatically moves aggregate demand in a stabilized fashion against whatever shock is happening, and nobody has to make an extra decision in that crisis. This type of policy is referred to as an automatic stabilizer. For example, even though it wasn't initially invented for this purpose, unemployment insurance would be an example of an automatic stabilizer. During a recession, more people are out of work, which automatically increases how much spending there is on unemployment insurance. thereby making the recession less severe than if there was no unemployment insurance. We have many types of automatic stabilizers in our economy already, such as unemployment insurance, such as, for example, the Supplemental Nutritional Assistance Program, often referred to as food stamps, and a few others. So far, though, we mostly have these automatic stabilizers by accident. Because we're trying to put together a policy to help people, it also happens to stabilize our economy. Perhaps in the future, we will become more aggressive in our use of automatic stabilizers and put parts of our federal budget on autopilot, where it automatically cuts spending during a boom and increases it during a recession. That concludes our discussion of the influence of monetary and fiscal policy. I will see you next time.